Management just authorized $30.9 billion in quarterly capital expenditure, yet Wall Street remains entirely captivated by a simple top-line revenue beat. Microsoft is spending an unprecedented fortune to win the artificial intelligence race. But does this aggressive infrastructure build-out mean the company is actually walking into a massive profitability trap just to maintain market dominance? Total revenue reached $82.9 billion this quarter. This represents an impressive 18% total revenue growth year over year. But how does a business generate that much fresh capital while simultaneously showing underlying structural cracks? At first glance, the mainstream narrative focuses entirely on the intelligent cloud segment, which delivered a 30% revenue surge. But when you dig deeper into the data, you find a very different dynamic playing out. The more personal computing segment actually reported a 1% revenue decline. Legacy technology platforms are quietly dragging on the momentum of next-generation cloud infrastructure. The golden rule for us in value investing is that top-line illusions often mask underlying structural shifts. Your investing strategy must account for when a company relies on a single engine to carry the entire plane. For example, maintaining a 1% revenue decline in hardware over multiple quarters eventually drains resources from faster-growing divisions. Microsoft cannot rely on its cloud division to subsidize stagnant consumer hardware forever. This brings us to how Microsoft funds that powerful cloud engine, highlighted by an operating cash flow of $46.7 billion. Generating that much cash makes the balance sheet look impenetrable, but where is that liquidity actually going? The mainstream view ignores cash outflows as long as earnings per share beat expectations, but the fundamental reality is found in the quarterly capital expenditure of $30.9 billion. Microsoft is currently consuming 66% of its operating cash flow just to fund capital expenditures. This unprecedented spending spree has compressed the free cash flow margin down to just 19.1%. Free cash flow margin represents the percentage of revenue left over after paying operating and capital expenses. That current figure is a sharp drop from the 29% free cash flow margin recorded in the prior year. This represents a significant liquidity drain as billions are redirected to build physical data centers. And this is exactly why relying on just the income statement is dangerous for your stock market analysis. Cash flow metrics tell the true story of how heavy the artificial intelligence crown really is. If capital requirements keep accelerating, that 19.1% cash flow cushion will evaporate even further. But to fully grasp why this capital drain matters, we need to look at underlying profitability. Operating margin expanded to an impressive 46.3% this quarter. Operating margin shows what percentage of revenue remains after paying variable production costs. Wall Street looks at that 46.3% operating margin and assumes the core business is perfectly immune to cost pressures. But the true fundamental cost of this transition is hiding further up the income statement. Gross margin actually contracted to 67.6%. Gross margin reveals direct profitability of goods sold before operational overhead. This represents a 110 basis point gross margin contraction year over year. The sheer cost of scaling artificial intelligence data centers, paired with massive depreciation, is quietly eating into core profitability. You are watching a fundamental margin squeeze unfold in real time. Will Microsoft sacrifice a 67.6% gross margin just to dominate the infrastructure market share race? The lesson here for your fundamental analysis is to always check gross profitability before celebrating operational efficiency. High depreciation costs are the silent killers of long-term wealth compounding. So what is management seeing that we are missing, given that commercial remaining performance obligations surged to $627 billion? Securing a 99% growth in these future revenue commitments seems almost impossibly high in this environment. Retail investors might assume this is just a clever accounting trick to distract from the massive spending. But the reality is that this $627 billion metric serves as the ultimate anchor for bullish investor psychology. Management is signaling an unprecedented pipeline of secured long-term enterprise demand. This is further validated by the artificial intelligence revenue run rate, which currently stands at $37 billion. That specific artificial intelligence revenue run rate represents a staggering 123% growth year over year. Azure Cloud Services also delivered 40% revenue growth, proving that enterprise adoption is accelerating rapidly. Microsoft is building a $627 billion backlog so massive that it insulates the valuation from short-term market volatility. It teaches us that markets will tolerate margin compression if you can provide concrete visibility into future cash flows. However, there is a fascinating tension building within the balance sheet regarding how management rewards its owners. Total capital returned to shareholders equaled $11.4 billion this quarter. How can Microsoft afford to return capital while facing such intense cash requirements for hardware? The mainstream media assumes that $11.4 billion in capital returned to shareholders is simply a sign of corporate health. Specifically, Microsoft paid out $6.8 billion in dividends and deployed $4.6 billion in share repurchases. But when you contrast this with rising infrastructure costs, a new fundamental risk emerges. The company is funding speculative future growth while satisfying immediate shareholder demands for yield. If capital expenditures continue to rise, investors may soon question the long-term sustainability of maintaining these buyback programs without deleveraging the balance sheet. Adding to this tension, we see a 30% inventory buildup on the balance sheet. When consumer hardware demand softens, the cash burden rests entirely on the cloud division. The timeless lesson for value investing is that capital allocation is a zero-sum game. Every single dollar spent repurchasing stock from that $4.6 billion allocation is a dollar not kept as a buffer against unforeseen infrastructure expenses. And this is something you can easily check for yourself in any financial report by comparing capital expenditures against share repurchases. This brings us back to the $30.9 billion in massive capital expenditure that initially captured our attention. The central conflict for Microsoft is managing the immense physical cost of fulfilling market demand. Contracting gross margins will likely persist as depreciation outpaces monetization. Microsoft is successfully executing a high-stakes transition that will redefine the entire enterprise software landscape. The unprecedented $627 billion backlog of commercial commitments ensures substantial revenue visibility. The business is fundamentally bifurcating into a high-growth cloud provider and a decidedly slow-growth legacy hardware business that drags on overall performance. The financial data clearly suggests Microsoft remains a compounding machine, but one entering a highly capital-intensive phase. The current pace of share repurchases will face internal pressure if the investment cycle requires elevated spending beyond projections. As an investor, your job is to monitor that 19.1% free cash flow margin closely. As long as commercial performance obligations continue to grow alongside capital expenditures, the fundamental thesis remains completely intact for the long term. Do you think this aggressive infrastructure spending will create an unassailable moat, or is the company walking into a costly trap? Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.